The stock market will crash. It's happened time and time again. This is the scary truth. However, it doesn't have to be a bad thing. If you're properly prepared, you can actually benefit from the chaos. Today, I want to share the knowledge that's helped me make millions through multiple market crashes. First, let's talk about how common a market crash is. There are 3 types of market declines that I want you to understand. Number 1, market correction. This is the most common type. It's defined as at least a 10% drop from a recent high. Think of it like the stock market taking a breath, realizing it's a bit overpriced, and adjusting. Corrections have happened about every 1.2 years since 1980. Number 2, bear market. A bear market is when prices have dropped more than 20%. Since 1932, we've seen these bear markets occur on average every 4 years and 8 months. Bear markets tend to drag on for around 9.6 months, but don't let that discourage you. Bull markets last much longer, usually about 2.6 years. Number 3, stock market collapse. This is the big one, a stock market collapse. I define this as a drop of over 30%, often within a very short time frame. These are rare, but they do happen. In fact, there have been times in history where one unexpected event could have triggered such a collapse. For example, imagine the potential fallout if a sitting president had been unalived. Not a political statement, just a look at how the market reacts to big shocks. The main takeaway? If you aren't mentally and financially prepared for the market to go down sometimes, you shouldn't be investing in stocks. How to predict a market crash. Now let's get into how you can spot a market crash before it happens. There are 3 key phases to watch for, and each requires a different strategy. I'll share what I've done during each stage, backed by real-life examples. This way, you'll be better prepared than most investors. Number 1, the euphoria phase. This is when everything seems too good to be true. The market is at its peak, and irrational excitement drives prices to unsustainable levels. You'll see blind happiness everywhere. When I notice this, I start preparing my investments for the inevitable drop. Before the 2008 financial crisis, I noticed 2 major things that made me cautious. First was the explosion of consumer spending. People were spending money like there was no tomorrow, and the economy seemed to be booming. It reminded me of more recent times, like the NFT craze. People were paying millions for JPEGs, which to me was a huge red flag. It's a classic sign of too much money in circulation. Second, I noticed that it was easier than ever to get credit, especially in real estate. People were refinancing or buying houses they couldn't afford, banking on the idea that if things went south, the banks could just repossess the homes without losing money. This was a massive warning sign. Most people were riding the wave, but I started preparing. I minimized my risk and reduced my exposure to highly speculative investments. At the time, my friends thought I was being overly cautious, maybe even paranoid, but I knew what was coming. During the euphoria phase, these are the steps I recommend. Evaluate and minimize your risk. Don't chase the highest returns. Focus on consistent, sustainable growth. Reduce your leverage. If you're using margin, pay it off. Build up cash reserves. I know holding cash during a bull market might seem crazy, but trust me, it's worth it. Diversify. Spread your investments across different sectors. Let me tell you, if you're new to investing, you might not have experienced a real crash yet. When your portfolio drops by 50%, it can feel terrifying. The question is, can you handle it? If not, you need to rethink your strategy before the crash hits. Number 2, the reckoning phase. This is the second phase. The market has started to crash, and reality sets in. Panic takes over. It's here where most people make the mistake of selling off their investments out of fear. When the market was crashing in 2008, even my 10-year-old son could sense something was wrong. My hobby store's customers vanished, and those who came in didn't spend much. But instead of panicking, I saw opportunity. Dollar stores were popping up everywhere, feeding off the supply of products from failing businesses. I realized that if they were buying things for cheap, so could I. So I started looking for great deals, not just in stocks, but in entire businesses. This is called dollar cost averaging. I kept buying week after week because I knew I wouldn't be able to time the exact bottom. But by consistently investing, I was positioning myself for the recovery. The truth is, human psychology plays a huge role in how you handle a crash. People who say they're long-term investors often panic when the market drops. But if you believe in your investments, you'll hold firm and come out the other side stronger. There's a famous story about investor Peter Lynch, who bought shares in Kaiser Industries during a huge dip. The stock kept falling, but because he understood the fundamentals, he held on. Eventually, the stock rebounded and he made a fortune. The lesson? If you don't understand your investments, you'll panic and sell at the worst time. If you like this kind of video, go ahead and like, comment, and subscribe to stay updated with videos like this. Number 3, the Phoenix phase. Finally, we reach the Phoenix phase. This is when the market starts to recover, rising from the ashes of the crash. It doesn't just recover, it usually pushes beyond the last market highs. After the 2008 crash, I noticed things starting to improve around 2012, just after the London Olympics. Businesses were hiring again, and money was flowing. But it took time for people to get comfortable spending again. Here's the key takeaway. After every crash, a bull market follows. If you've been buying during the downturn, your investments will grow dramatically as the market recovers. I've seen this happen after Black Monday, the dot-com bubble, the 2008 financial crisis, and even the 2020 pandemic. The seeds of your fortune are often sown during the darkest times. By consistently investing, diversifying your portfolio, and sticking to your plan, you'll be better prepared than most to capitalize on the recovery. The key message is that while market crashes can be unsettling, they offer some of the best opportunities for long-term wealth creation. By consistently investing, diversifying your portfolio across sectors, and maintaining a disciplined approach, you can weather downturns and capitalize on the eventual market recovery. The principle here is that by not panicking and sticking to your strategy, you position yourself for significant gains when the market rebounds, which it almost always does. Staying calm and making informed decisions during volatile periods is crucial to financial success. In terms of future trends, market volatility is expected to remain a constant, driven by factors like global economic shifts, geopolitical tensions, inflation, and rapid technological advancements. These factors may lead to more frequent market corrections or even crashes, but they will also create opportunities for savvy investors who are prepared. Additionally, with the rise of algorithmic trading and AI-driven market analysis, investors will likely have more tools at their disposal to predict market movements and manage risks. We can also expect a shift in how people invest. There's growing interest in alternative investments like cryptocurrencies, decentralized finance, DeFi, and other digital assets that could provide new avenues for diversification, especially in times of economic uncertainty. Moreover, ESG, environmental, social, and governance, investing is gaining momentum, with investors looking to align their portfolios with socially responsible causes. This trend is expected to grow as more investors prioritize sustainability and ethical considerations alongside profitability. Another important trend is the democratization of investing. With platforms that offer fractional shares, robo-advisors, and no-fee trading, access to the stock market is more inclusive than ever before. This is empowering a new generation of investors to engage in the market, and many will learn how to benefit from downturns by adopting long-term strategies like dollar-cost averaging and portfolio diversification. In summary, while the stock market will always experience ups and downs, those who prepare by staying diversified, thinking long-term, and being ready to act in times of crisis will continue to find opportunities for growth. Future trends suggest that while market volatility may increase, technological advancements and alternative investments will offer new strategies for savvy investors to capitalize on the inevitable market recoveries. If you want me to walk you through exactly how to get started investing in the stock market, I've got another video for you right up here. But don't click on it just yet. Make sure to subscribe if you want to grow your wealth and stay informed about the market. And remember, crashes don't have to be something you fear. They can be opportunities to build real wealth if you're prepared. All right, I'll see you over in that video.